Good afternoon, students. You are viewing the BOS for Success session of Intermediate Paper 4A, Income Tax Law. I am Priya Subramanian.
And I am CA Dimple Goel.
Yeah, together we'll be taking you through some of the important concepts through MCQs and case scenarios over the different chapters of the income tax law. But before that, as regards the applicability, all of you must be knowing by now what is the applicability. First, it is the amendments made by the Finance Act 2022, notification circulars issued up to 34/2023 will be applicable, 6 months cutoff date. So up to 34/2023 will be applicable for November 23 exam. The relevant assessment year is assessment year 23-24. So your study material is May 2022 edition. 30th April 2023.
22. Okay, 23.
So, whatever the amendments are there by the Finance Act, they have been incorporated in your study material. The amendments after the date of the study material, that is from 1st May 2022, 34/2023, that is given as a statutory update. The statutory update is available at the BOS knowledge portal, and it contains some important amendments. This time amendments in the sense guidelines on 194I, certain things relating to furnishing of PAN and all those things. So those are important. So you have to read that also along with your study material. In addition, we have web-hosted case scenarios and MCQs, which are relevant for May 23 and November 23 examination. So you have to work out those case scenarios and MCQs. We'll be doing some of them for you because there may be students, we get queries often that you're not able to solve this particular MCQ, this particular concept you're not able to understand. So on that basis, we've selected MCQs across chapters and case scenarios, a couple of case scenarios, and through that we will be covering important concepts. So as far as this subject is concerned, one thing which you have to keep in mind at the income tax level, it is a computation of total income and tax liability or tax payable, in fact, of an individual. So what happens right from determination of residential status, which is the very first step, you have to determine the residential status correctly. If that goes wrong, everything else will go wrong because that determines the scope of your total income. So by and large, you will get for the resident. If nothing is mentioned, you generally assume it's a resident and you go ahead with that. But there may be questions which first involve, which contain information relating to determination of residential status, and thereafter they will give you 2-3 income. We are taking up a case scenario like that for you. So there it becomes very important. Suppose a person is a non-resident. You cannot include the income which he earns outside India in his total income computation. So first, if the question contains information relating to his stay in India, you have to compute his residential status, ensure that he's a resident. Then thereafter compute the income. Because global income is taxable in case of a resident and ordinarily resident. In case of a non-resident, what income you accrue or accrues or arises outside India, which is not deemed to accrue or arise in India, and which is not received in India, those things will not, such income will not be taxable. So that you have to be very careful about residential status. That's the first step. Afterwards, everything like income which do not form part of total income, of course, agricultural income is there regarding that. And then how do you do partial integration? That is also contained in that particular chapter. And all the heads of income. Every head of income is in a question on computation of total income and tax liability. You can get any head of income. So you cannot afford to leave out anything. See, as such, we have ourselves, considering the level of knowledge expected at intermediate level, excluded many provisions by way of study guidelines. So whatever remaining and whatever are relevant for you are only included in the study material. So that you should ensure that you're fully thorough with. All the provisions, to apply them correctly. That how do you ensure? By solving the illustrations, solving the question knowledge questions on your own. And thereafter comparing the answers with the given answers. Only then you'll be able to identify the mistakes. If you directly look at the answers themselves, you'll feel that you've understood everything. General human tendency, this is the way I have to do, I have understood it. So then you will never be able to find out where you go wrong, and ultimately in exam you'll end up struggling. So advise you read the concepts in the study material and do the problem solving on your own and thereafter compare it with the answers given in the study material. This is for all chapters. In fact, for many chapters like heads of income, we have given computation charts itself. I'll just take it. Now let us see, this is a chapter on salaries. Okay. The beginning of what I wanted to say in the beginning of the chapter on 5 heads of income, we have given you how to go about computing the income in case of salaries. See, this computation chart is there in the salaries chapter. It tells you how to go about what are the exemptions available for HRA, for children education allowance, for transport allowance, for perquisites, how do you go about computing. So it is very essential that you read all these read your study material and then go through the computation chart. There's a let us recap at the end of every chapter, which helps you recap all the provisions learned in this chapter. So by doing the study material, you get your concepts get very clear. And thereafter, you'll be able to apply it correctly with the help of illustrations and problem solving. In case you go wrong also, the methodology is given there. How do you compute is always there. When you compare, you'll know you've gone wrong in this step. So you'll accordingly correct yourself. Like that, each head of income is important, then clubbing, set off. Then thereafter, you get the gross total income. After you apply the 5 heads of income, clubbing provisions, set off provisions, you get the gross total income. Then the deductions from gross total income you have to provide. You get the total income, and thereafter you have to compute the tax liability, applying the special rates, general rates, the special rates for capital gains, then lottery income. Thereafter, remember, if they ask you for tax payable, you have to deduct TDS if any. Only then your answer gets complete. Tax liability, you can start with determining the tax liability, but if it's tax payable, you have to deduct the TDS advance tax and then compute the tax payable. So each and every chapter is important. So that's what I'm telling you. Study material, your knowledge is very, very important that you read the study material, go through all the concepts there, then see the computation chart once. That will give you a clear picture on how you should go about and what are the things. Once you read the chapter and you read the computation chart, you will be very clear on how you have to go about computation under that particular head. Thereafter, you can solve the MCQs and case scenarios web hosted, and revision test papers, of course, contains very good questions. So standard questions where you really have to apply whether you've understood the concepts very clearly. Do that also on your own, and thereafter compare your answers.
Yeah, and after completing your RTP or revision test paper, you can just go for the MTP, mock test papers, because the mock test paper will give you the scenario of your examination, because it will be a 3-hour paper, and it gives you a analysis of how much you have prepared and how much you are able to complete in a particular time frame. Like if you sit for a taxation paper, the taxation paper consists of income tax law and GST also. So if you sit for 3 hours and you attempt your MTP in that scenario, examination scenario, you will know the pressure that how you handle, and you have to manage your time accordingly to complete the paper within 3 hours. So it will you will come to know that how much how to enhance your speed, or how to complete your paper, how much time you have to devote for MCQs, how much time you have to devote for each and every questions. So that is very important for the time management, because many students complain that they could not complete their paper in the 3 hours. So for that, it's very necessary you just sit for the MTP. There will be 2 series of MTP. One is already conducted and the second will be in the next month. So it is very much advisable that you attempt your MTP, and in that within that time frame only of 3 hours, to try to complete the MTP. And after completing it, then you compare your answers with the suggested answers of MTP to compare whether where you have done the mistake, and where the concept is not clear, or where you have not understood the provision. So it will give you an idea that this is the thing, this is the provision which you need to work upon, and this is the mistake which you are doing. So it is very important that you go through the took the MTP also. Regarding the study material, I have a query that one student is asking that she has a revised edition, June 2021 study material edition. So is it okay to study from that?
Yeah, for tax, it's better to get the latest
study
because June 2021 material will not contain amendments by the Finance Act 2022. And it's better you study from the latest study material. It's web hosted also. In the BOS knowledge portal, it's available. Just open it and read from that. We will not advise you to, especially since the study material is available at the intermediate level, you might find it all the more difficult to correlate.
Yeah. So it's better to go to the May 2022 edition of the study material rather than the June 2021 edition of the study material.
Some student, Nehal Gupta, has asked, when calculating taxable income in clubbing of income chapter, we account for all deductions available anyway, but why don't we also deduct standard deduction from the salary head? Actually, when you do a clubbing provision, say if you do for a minor, whatever clubbing provisions, whatever head it is taxable will be in the same head, it will be included in the hands of the parent also. And whatever deductions are available, they will be eligible for those deductions. We will take examples of clubbing also when we are covering the chapters. Yeah. Okay. Now, as I said, residential status is the most important chapter in the, most important is the fundamental thing based on which you have to, your income will be computed. There are questions which focus on residential status and thereafter give you some items of income so that based on the residential status, you can determine your total income. For that, you have to have an understanding of the residential status. So, which is this here? That one. Okay. Okay. Now this chart will help you understand. I hope the chart is visible to everyone. Can somebody please reply whether the chart is visible on the screen?
Nehal, Mohit, anyone can reply whether the
Chart is
visible on?
Nobody is answering. I presume that it's visible, whatever. So residential status of an individual basically depends upon the number of days of his stay in India. So certain minimum days of stay in India has been prescribed in section 6.1. And if that criterion is satisfied, you become a resident. So there are three things, like three residential status basically. Resident and ordinarily resident, resident not ordinarily resident, and non-resident. Okay. Now, based on the number of days of stay in India, we will determine. So basically, if an individual has stayed in India for 182 days or more in the relevant previous year, he becomes a resident. Alternatively, he can be a resident if he stays in India for 60 days in the relevant previous year and 365 days in the 4 immediately preceding previous years. For example, relevant previous year, this is your assessment year, is assessment year 2023-24. So what is your previous year? Previous year is 2022-23. So whenever I'm telling relevant previous year, for your November 23 exam, the relevant previous year is 2022-23. Okay. So if an individual has stayed for more than 182 days, in the relevant previous year, he becomes a resident. Alternately, if he has stayed for 60 days or more, plus 365 days in the 4 immediately preceding previous years. What are the 4 immediately preceding previous years? 2021-22, 2021, 19-20, and 18-19. So these are the 4 immediately preceding previous years. In these 4 years, if he had stayed for 365 days or more, plus 60 days in the or more in the current year, then also he becomes a resident. But there are some special cases when the second condition is not applicable. That is 60 plus 365 days is not applicable, or they are applicable in some modified form. So we will see what are those cases. First, in the case of an Indian citizen leaving India in the relevant previous year, in the previous year 2022-23, for employment or as a member of a crew of an Indian ship. An Indian citizen, first of all, Indian citizen who is leaving India in the previous year 2022-23 for employment purposes or as a member of a crew of a ship. He will be treated as resident only if the stay in India is for 182 days or more. The second condition would not apply to him. That is what it's given. Tick against the first condition, cross against the second condition. Now, this is over. Then another one is an Indian citizen or a person of Indian origin residing outside India, ordinarily residing outside India, who comes on a visit to India. Visiting, he is not returning permanently. If he is returning permanently, then this condition won't apply. Indian citizen or a person of Indian origin. Person of Indian origin is he or his parents or his grandparents were born in undivided India. That's a person of Indian origin. Or he's an Indian citizen. And he is residing outside India. He is visiting India. Okay. And then here again, there are two things depending upon your total income. If your total income, excluding income from foreign sources, is less than or equal to 15 lakh, then here again, the person will be treated as a resident only if the stay in India is for 182 days or more during the relevant previous year. But if your total income, excluding income from foreign sources, is greater than 15 lakh, in case of an Indian citizen or person of Indian origin residing outside India who comes on a visit to India, in such a case, then the first condition is there, anyway, 182 days or more. Second condition applies in a modified form. It is greater than or equal to 120 days in the relevant previous year, plus 365 days in the 4 immediately preceding previous years. Both the conditions has to be seen together. Simply, if he stayed in India for 120 days in the current year, won't make him unless he stayed in India for 365 days in the 4 immediately preceding previous years. Okay? Now, how do you compute total income excluding income from foreign sources? So, what is excluding? Income from foreign sources is what? Income from foreign sources is an income which is deemed to accrue or arise outside India, and which is not income which accrues or arises and which is not deemed to accrue or arise in India. Section 9(1) contains many provisions when it's deemed to accrue or arise in India by virtue of a business connection, salary income if it is paid outside India by the government of India to a person who's citizen who's going out of India. There's many other provision, fee for technical services, royalty, and all those things. There, even though it's outside India, it's deemed to accrue or arise in India. So it should not be such a case. So it should be an income accruing or arising outside India, which is not deemed to accrue or arise in India. Such income will be excluded. We will go through, because we are going to take up some examples. Probably you'll understand better with those examples. That income should be excluded. Foreign income should be excluded. However, income from a business controlled from a profession set up in India, that has to be considered for determining the total income. Okay. Then if your total income is less than 15 lakh, less than or equal to 15 lakh, then you have to see only the 182 days condition. If it is greater than 15 lakh, then you have to see compliance of both the conditions, 182 days conditions, or if that is not fulfilled, 120 plus 365 days condition. I hope this is clear. Deemed resident. So now all these provisions are contained in 6(1). Okay. Now 6(1) says that 6(1) is a deemed resident, where an individual who is an Indian citizen again, whose total income here again it should exceed 15 lakh, who is not liable to tax in any other country. Okay. In such case, there's no requirement that he should have stayed in India. Okay. He is automatically deemed to be a resident in India. Okay. But there are some conditions. If these people are deemed to be resident but not ordinarily resident in India. Okay. Now, what is R and OR? Now we know what are the conditions for resident. When you should apply 182 days plus 60 days. When you should apply only 182 days. when you should apply 182 days or 120 days plus 365 days. So that I hope it is very clear from this chart. Okay. Now, it's not enough if you determine whether the person is a resident. From that, you won't be able to make out. You have to find out whether he is ordinarily resident or not. For that, there are two additional conditions. These additional conditions should be applied only if they are resident as per 6.1. Only if the status is resident as per 6.1, you have to see the additional condition. If the status is non-resident, then there is no need to see these conditions. Okay. So if the person is a resident as per 6.1, then the additional conditions are 730 days in the 7 immediately preceding previous years, greater than or equal to stay in India. Resident for greater than or equal to 2 years out of the 10 immediately preceding years. So if both the conditions are satisfied, if he stayed in India for 730 days in the last 7 years and is a resident for 2 years or more in the last 10 years, then he will be a resident and ordinarily resident. In case of a resident and ordinarily resident, global income is taxable. That is, irrespective of whether you earn it in USA or Canada or India, it is taxable, unless specific exemptions are provided in the Act. If one of the conditions are satisfied, or if both the conditions are not satisfied, then the person becomes a resident and not ordinarily resident. Okay. In case of a resident and ordinarily resident, the income earned outside India will not be taxable unless it is from a business controlled from or profession set up in India. So the only additional income over and above a non-resident, which is taxable in case of an RNOR, is income from a business controlled from a profession set up in India. Okay. Now, these conditions have to be seen in all cases except 2 cases. One is where a person becomes a resident by virtue of the 120 days plus 365 days condition. An Indian citizen or a PIO residing outside India, visiting India during the relevant previous year and having total income greater than 15 lakh. And if that person becomes a resident because of application of the second condition, 120 days plus 365 days, then he is by default a resident and ordinarily a resident without seeing any additional condition. He would be an RNOR by default. Likewise, a person who is deemed a resident under 6.1, Indian citizen who does not have any, not liable to tax in any country and whose total income excluding income from foreign sources is greater than 15 lakh, he is also by default a resident and not ordinarily resident. So in these 2 cases, the only additional income which will be taxable in the hands is an income from a business setup or professional business controlled from a profession setup in India. We'll take you through few illustrations where you will be able to understand it. In meanwhile, we are getting everybody's questions, but when I'm doing one particular concept, I should finish it. Now, Bhishma, if I go to your question, it will become difficult. Mohit Singh, what was your question? Go up.
There's no question from Mohit.
There's nothing, no? Your messages are reaching, Mohit, but I haven't got any question of yours. Okay, and somebody who's not mentioned the name clearly, they have written, can you please tell question 1, which is compulsory question, usually comes from which all chapter? Question 1 encompasses the whole syllabus, as I said. It can cover any heads of income. It can cover your clubbing. It can cover your set-off. It can cover your deductions. It can involve computation of total tax liability. So, all your chapter 4, fully it can cover. Chapter 4 is all heads of income. Chapter
TDS
5,
also.
6, 7. TDS also it can cover because TDS is there if you have to deduct it from your tax payable. That's what I'm telling you. You can't afford to leave out anything. Ultimately, your chapter 8 on computation of total income and tax liability is nothing but after you've understood everything, you have to integrate, apply all that to compute your total income. Whatever individual things you are learning in chapters, you have to apply it. Additionally, you have your AMT, you have your 115 BAC, that is there. But all chapters will come. So you can't afford to leave out anything. Anyway, income tax is such an interesting subject that once you start reading it and once you start doing it, you'll automatically won't feel like leaving any chapter. So you don't go with a preconceived notion, look, PGBP is very difficult, because it's not at all difficult. At least at the intermediate level, it's not at all difficult. Similarly, capital gains, Though it might be slightly difficult as compared to the other heads of income, but it's very interesting. So once you start doing it, you develop an interest for the subject, then it is a cakewalk. So, but you have to be careful about certain common mistakes which students tend to make. You know, if you don't read it properly, any particular sentence properly, if you leave out any particular this one, then your interpretation, everything can go wrong. Like suppose a person is covered by Payment of Gratuity Act, not payment, is not covered by the definition of salary changes. So these are small things which you have to keep in mind. So if you miss out on any particular point, or if you read the question too fast, and you know, like that's why it's important to read the question very carefully, and you miss out some important thing that might lead to a wrong answer. So that you need to take care, but otherwise the subject is very, very interesting and it's very scoring also. Let's go to this MCQs. So with these MCQs, probably you will be able to understand residential status clearly. So I'll ask you whether you've understood after doing the illustrations. Because right now, so Mr. Square is an Indian citizen. He currently resides in Dubai. He came on a visit to India and his total stay was 135 days. So here it's important, he's an Indian citizen. He's visiting India and his stay was 135 days. And he is not liable to pay any tax in Dubai. Following are his details of stay in India in the preceding previous years. So preceding previous years, they've given you the details of his stay. So if you add that 11 plus 3, 14, carry 1, it's coming 414 days, preceding 4 days. So he's an Indian citizen. He's residing in Dubai. He's visiting India, coming on a visit. So which condition will apply? Two things can apply. We haven't seen his total income as yet. Indian citizen residing outside India, visiting India during the relevant previous year. See, in the normal case, if his total income is less than or equal to 15 lakh, then only the 182-day condition will apply. If it's greater than 15 lakh, then you have to see 182-day condition and 120 plus 365 days condition. Okay. Now let us see what is the question. Okay. What will be his residential status for the previous year 23? If his total income other than income from foreign sources is 10 lakhs that they've given you on the question itself. See, you don't need to compute here. It's less than 15 lakh, less than or equal to 15 lakh total income other than income from foreign sources. So now what condition will apply? What condition will apply? I'm waiting for your answers. Which condition will apply for this person? Is it 182-day condition or 182 plus 60 days, 60 plus 365-day condition, or 182, 120 plus 365-day condition? Which condition will apply for him? His total income is less than or equal to 15 lakh. Okay. Though in his case, he is there in India in the current year for greater than 120 days, and in the previous 4 years he's there for greater than 365 days. But this condition is not applicable to him. Why is it not applicable to him? Because his total income other than income from foreign sources is less than 15 lakhs. It's only 10 lakhs. So this 120 365 days condition will not apply to him. Correct, Bhumika, it's 120 days. So the condition which is applicable to him will be for a person who has total income less than 15 lakhs. So the condition which applicable to him is if he should have been in India for at least 182 days to be treated as a resident. Fine. Okay. Now he is not there in India for 182 days. He is there only for 135 days in India. So he becomes a non-resident as per 6(1). Now, does it get over with that? Based on this, can I answer he's a non-resident? One more thing which I'll have to see is that 6(1)(a). If he is a non-resident as per 6(1), then only we come to 6(1)(a). Okay. In this case, he's a non-resident as per 6(1). So we come to 6(1)(a). He is residing in Dubai. Dubai, he is not liable to pay any tax in Dubai. Okay, and he is an Indian citizen. He's satisfying those conditions. Indian citizen, he's residing in Dubai where he does not have to pay any tax. Okay. And if here, for deeming a person to be a resident, you don't require any day of stay in India. There's no condition of stay in India. But what is another important thing which you have to see? In 61A also, the total income should, other than income from foreign sources, should be greater than 15 lakh. In this case, since it's only 10 lakh, 61A will not apply to him. Even though he's an Indian citizen, he stays in Dubai and he doesn't pay tax in Dubai, still 61A will not apply, and he is a non-resident as per 61. All the other conditions are satisfied, but because his total income is less than 15 lakh, he is a non-resident. He is not a deemed resident. 61A does not apply to him. I hope this is clear. Bhumika, Dipanshu, Mohit. So the answer will be non-resident. Answer is non-resident. As per 61, he is a non-resident. 61A is not applicable because his total income is greater than, is lesser than 15 lakh. Okay.
Is it clear, students? So that we can go to the next MCQ. That is also
So
based on.
We have taken 3 MCQs on residential status so that you get the concept clear. Residential status of an individual is no doubt difficult. It has become difficult because of introduction of 61A and this 120 plus 365 condition because of all that. But once you get the hang of that, it is not so difficult. Once you start solving some questions and you have that chart in front of you, things are not so difficult. Initially, it will take probably an hour or two for you to assimilate. But once you start solving problems, then you will be clear in it. Okay. Now, Rajesh, aged 53 years, and his wife Soumya, aged 50 years, are citizens of country X. So first what? They are not Indian citizens. They are citizens of country X. They are living in country X since birth. They are not liable to tax in country X. So, but they are not liable to tax in country X, but 61A can anyway not apply to them because they are not Indian citizens. This should strike you immediately. Because in 61A, it's not that they can be a person of Indian origin and all. It's applicable only to Indian citizens. So in this, we can make out that 61A is not applicable to them at all. Anyway, we have to see whether he's a resident as per 61 first before coming to 61A. But it's clear. Certain things are very clear now since they are citizens of country X. Okay. Both of them have keen interest in Indian culture. Mr. Rajesh's parents and grandparents were born in country X. So Rajesh is not a person of Indian origin. So if you see Rajesh, he is not an Indian citizen. He is not an Indian citizen. And he is not a person of Indian origin. Okay. Now Soumya. Soumya visits India along with Mr. Rajesh for 4 months every year to be with her parents, who were born in Delhi and they have always lived in Delhi. Her grandparents were also born in undivided India. So what does you know? Soumya is not an Indian citizen. That is given because she is a citizen of country X. Okay, not an Indian citizen. But she is a person of Indian origin. Soumya is a person of Indian origin. And Rajesh, but he is not an Indian citizen, not a person of Indian origin also. Okay. Now, during their stay, they come and stay in India for 4 months every year. Okay. So, approximately you can take 120 days ke upar. It has to be more than 120 days. 4 months means because 130, 31, 30, 31, even if you take the February month into consideration, the January, December and March has 31 days. So, you will have 121 days even in such a case. Even if you take February into consideration, it's 121 days. So their stay in India is greater. Current year, it's greater than 120 days. Every year, it will be greater than 120 days. So earlier previous years, it will be 480 days. So during the stay in India, they organize a cultural program. Income of Mr. Rajesh and Mrs. Soumya from Indian sources is 18 lakh and 16 lakh respectively. Here also they've given Indian sources, they've given 18 and 16 lakh. Both cases it exceed 15 lakh. Okay. Now, but which condition will apply to whom? I'll take you back to that particular chart, residential status. So, if you see say this one, exceeding 15 lakh. This is a case where an Indian citizen, a person of India, a person of Indian origin, Soumya fits into this definition. Indian citizen, neither of them are Indian citizens. Soumya fits into person of Indian origin. So in case of Soumya, she is residing outside India. She is visiting India. She is having total income, excluding income from foreign sources, greater than 15 lakh. Okay? So for Soumya, 182 days condition also you can see, which she doesn't satisfy because she's here for 4 months only. Second condition she satisfies, 120 days plus 365 days. She stays in India for greater than 120 days in the current previous year. And every year she comes for 4 months. So she stays for 365 days in the 4 immediately preceding years. So Soumya will be resident and by default she will be not ordinarily resident. Because you need not check additional conditions if she is becoming resident by virtue of 120 days plus 365 days condition. Hopefully this is clear. So Soumya is R and OR. Now what about Rajesh? Rajesh is neither an Indian citizen nor a person of Indian origin. So he will not fall in this, and his income, he is not falling in this. So of course these things don't apply to him. Indian citizen leaving India, outside India, Indian, here the income should be less than 15 lakh. In either case, he is not a citizen or a PIO. So for him you have to see the basic conditions, both basic conditions. Person not citizen, not person of Indian origin, you have to see 182 days and 60 plus 365 days. Okay. 182 day condition he doesn't satisfy because he stayed in India for 121 days. But 60 plus 365 days condition he satisfies. Okay. So 60 plus 365 days condition he satisfies. So he becomes a resident in this year. In this way, what will happen? He'll be a resident in all years. Because every year he'll be satisfying the 365 day condition because they come on a visit for 4 months. So 60 days, earlier years, 365 days, every year he'll satisfy that condition. So obviously he'll be resident for greater than 2 years out of 10 years. In fact, he'll be resident for all the years. 730 days, 120 into 7. 121, 120, whatever, into 7. Years. 0, 7 2s are 14, 840 days he stays. So this condition also he satisfies. This condition also he satisfies. Both the additional conditions he satisfies. So Rajesh is ROR, R and ROR, resident and ordinarily resident. Soumya is resident but not ordinarily resident. Is this clear? Rajesh, you're not seeing the special condition because he's neither Indian citizen nor person of Indian origin. So the general condition will apply to him. 60 plus 365 days condition he satisfies. So that will be applicable for him. By virtue of that, he becomes a resident. Once he becomes a resident, you have to see additional condition. He is a resident every year because every year he satisfies the 60, 365 days condition. Because general statement they have given, they visit India along with for 4 months every year to be with their parents. Every year they are visiting 4 months. So every year he'll be a resident by virtue of satisfaction of 60 plus 365 days condition. And because he's there for 120 days into 7, 840 days, it is greater than 730 days. So both the additional conditions he satisfies. So he's an R and OR. For Soumya, because she satisfies 120 plus 365 day condition, she is by default a resident and not ordinarily resident. You need not see satisfaction of additional conditions. Is it clear? Everybody? Mohit, Naman, Bhumika and Dipanshu has written they are clear. Bhumika, Naman, Chanchal, Harini, all of you clear? We have one more example on residential status. I'm waiting for your response. Otherwise, I presume that everybody has understood. Sushant. Sushant is a person of Indian origin, PIO that they've given, residing in Canada. During the previous year, 22-23, he visited India on several locations, visited India. PIO visiting India. And his period of stay in total amounted to 129 days. And his period of stays in India during the 4 immediately preceding years they've given. 135, 115, 95, 125. How much? 470 days. It totals to 470 days. Actually, From this, you can see he is satisfied 120 days in the current year plus 365 days in the earlier previous year's condition. But first of all, whether the condition applies to him. For that, the condition will apply to him only if his total income exceeds 15 lakh. That they have not, in the earlier two questions, they have given it directly. So here we have to compute that. Okay. Okay. Now these are the 4 sources of income. Okay. So what sources will take into consideration? Indian sources will take. Income received or deemed to be received in India, we will take. Accruing arising, which is deemed to accrue arise in India, we will take Indian income. Accruing arising and received outside India from a business controlled from India. For computing that 15 lakh limit, you have to take this also. If it's from a business controlled from India, that then you will have to take. Income accruing or received outside India from a business controlled outside India. Receipt is outside India, accrual is outside India, business is also controlled outside India. This is a foreign source income. So this you should not consider. These 3 together, the total will be 2,50,000, 3,75,000, 5,50,000, 5, 12 plus 5, 17, 11,75, is it? 11,75,000. So the total income excluding income from foreign sources is 11,75,000. So this income, 11,75,000 is less than 15 lakh, isn't it? If it's less than 15 lakh, then the 120-365-day condition will not apply. 120-365-day condition will apply to a person of Indian origin visiting India only if the total income excluding income from foreign sources is greater than 15 lakh. In this case, it's only 11,75,000. So that condition will not apply. So what condition you have to see in that case? In that case, you will have to see income less than 15 lakh. 1 minute. It's less than 15 lakh, na? So you have to see this condition. Here it's only 182 days condition they have to satisfy, which in this case, they are not satisfying. She stayed in India only for 129 days in the current year. So they are not satisfying the 182 days condition. This condition is not applicable because their income is lower than from Indian sources is lower than 15 lakh. So by virtue of that, what is their residential status now? It's a non-resident because he doesn't satisfy 182 days condition. So non-resident. So the question asks for what? Question ka requirement, what is the residential status and is income liable to tax? Now you know the residential status is non-resident. What is the income liable to tax? In case of a non-resident, income liable to tax will be income received or deemed to be received in India, income accruing or arising or which is deemed to accrue arise in India. Business controlled from India, we are taking for the purpose of computing total income excluding income from foreign sources. But after determination of residential status, if the person happens to be RN resident and not ordinarily resident, then you can include this also, if that was the result. But now, what is the result? What is the residential status? It's non-resident. In case of a non-resident, income accruing or received outside India from a business controlled from India will not be taxable. It's taxable in case of R and OR only, not in case of a non-resident. So only these 2 incomes will be taxable. 2,50,000 plus 3,75,000, which will come to 6,25,000. So the residential status is non-resident and the 6,25,000 is liable to tax in India. So A is the correct answer. Is it clear? Yeah, he is non-resident because he stayed in India for less than 182 days condition. Right, Bhumika. 120-365 does not apply to him because his income from India total income excluding income from foreign sources is less than 15 lakh. It's only 11.75 lakh. These 3 things included, it's 11.75 lakh. Because it's less than 15 lakh, then the additional condition 120 plus 365 days condition will not apply. Only the 182 day condition you have to. Since his stay in India is less than 182 days in the previous year, he becomes a non-resident. And for non-resident, what is the scope of total income? Only income which is accruing arising in India, income which is received in India, income which is deemed to accrue arise in India. So those are the first 2 only the first 2. Because the third one is income accruing arising outside and received outside India. from a business controlled from India, it's taxable only in case of a not ordinarily resident. Of course, in case of a resident, everything is taxable, but this is not taxable in case of a non-resident. So the answer becomes 6,25,000. I hope this is clear. Residential status, we've spent a long time on that. We've taken 3 questions on residential status just to clarify, especially what we've talked about in all the 3 examples is a person who's staying outside India. What happens if he is an Indian citizen or a person of Indian origin who's visiting India? If he is not an Indian citizen, not a person of Indian origin, then the basic conditions will apply. Then you can't see the special condition. Only if he's a person of Indian origin, if he's the person of Indian origin or an Indian citizen who's visiting India, and then of course, if the total income is less than 15 lakhs, then only 182 days condition. If it's greater than 15 lakhs, then you have to say 120 plus 365 days condition or the 182 days condition. If by virtue of 182 days condition he becomes a resident, then you have to see satisfaction of additional conditions. If by virtue of 120 plus 365 days condition the person becomes a resident, then by default he becomes a not ordinarily resident. Hopefully it's clear. We'll move to the next topic.
So now we move to the next MCQ, that MCQ number 4. Mr. Ramesh, a citizen of India, is employed in the Indian Embassy in Australia. He is a non-resident for assessment year 23-24. He receives salary and allowances in Australia from Government of India for the year ended 31st March 2023 for services rendered by him in Australia. So he is a non-resident in the current previous year, and he has received some salary and allowances from the Government of India and for services which he has rendered in Australia. So in addition, he was allowed perquisite by the government. So which of the following statements are correct? So first of all, in case of a non-resident, we have to determine what all the incomes is taxable in the hands of a non-resident. First, as we have already discussed, in case of a non-resident, income which is received in India, income which is accrue or arise in India, income which is deemed to received in India, or income which is deemed to accrue arise in India is the only income which is taxable in the hand of a non-resident. This non-resident, Mr. Ramesh, who is a citizen of India, he has given this rendered the services outside India. So whether this income, this is not the income which is accrue arise in India, but we have to see whether this income, this salary and allowances and the perquisite which he is getting from the Government of India for services rendered outside India, is the income deemed to accrue arise in India or not. So as per section 9, if we go to section 9, section 9 provides us the income which is deemed to accrue arise on India, in India, whether or not it is accrue arise on India or not. So in this case, section 9, subsection 1, clause 3 provides that if income under the head salaries is payable by the Government of India to a citizen of India, to a person who is a citizen of India for services which he has person rendered outside India. So the salaries will be deemed to accrue arise in India. So in this case, income under the head salary means the salary, allowances and perquisite, all the 3 are under the head salaries. These are payable by the Government of India to a Mr. Ramesh, who is a citizen of India, for the services which he has rendered outside India. So in this case, the salaries will be deemed to accrue arise in India as per section 9, subsection 1, clause 3. So in case of a non-resident, it is deemed to accrue arise on India. But there is some exemption which is given under section 10, clause 7, which says that if allowances and perquisites paid or payable outside India by whom? By the government to the citizen of India for services rendered outside India, then there will be an exemption from the allowances and the perquisite. It means that allowances and perquisite will be exempted in the hands of a person. So in this case, it is deemed to accrue or arise in India, but there is a specific exemption under section 10 clause 7 in which there is an exemption from allowances and perquisite. So which is the only income which is chargeable in the hands of Mr. Ramesh in this case is the salary income, which is because it is deemed to accrue or arise on in India. So what will be the correct answer in this case? Salary, allowances and perquisite received outside India are not taxable in the hands of Mr. Ramesh since he is a non-resident. It's a wrong answer because it is deemed to accrue or rise in India. So it's not, we can't say that it is not taxable in India. Salary, allowances and perquisite received outside India by Mr. Ramesh are taxable in India since they are deemed to accrue or rise in India. This is an incomplete statement because they are deemed to accrue or rise in India, but there is a specific exemption under section 10 clause 7 regarding the allowances and perquisite. Option C, salary received by Mr. Ramesh is taxable in India, but allowances and perquisite are exempt, which is the correct answer. And the fourth option, salary received by Mr. Ramesh is exempt in India, but allowances and perquisites are taxable, which is a wrong option. So what would be the correct answer? Answer C. So firstly, you have to see whether the income, particular income is taxable in the hands of the person or not. Because he is a non-resident, we have to see whether the particular income is taxable in his hand or not. And if there are certain exemptions are provided under section 10, so we have to see whether they have exemptions are provided in respect of that income and all the conditions, what all the conditions specifically written for that exemption are satisfied or not. In this case, the conditions are it should be payable by government, it should be payable to a citizen of India for services rendered outside India. So these conditions, three conditions are same in section 9(1)(3) also and in section 10(7) also. But the difference is that when deemed to accrue or rise in India, its salary, complete salary is deemed to accrue or rise in India, but exemption is provided only in respect of allowances and perquisite. So there is no exemption regarding the other salaries, basic salaries, and all this. So salary itself is taxable in India and allowances and perquisite are exempt. So I hope this is clear to all and there is no doubt regarding that. Naman, Dipanshu, is it clear? Yes, Bhumika, C is the correct answer. Salary received by Mr. Ramesh is taxable in India, but allowances and perquisites are exempt. So I am presuming that all of you understand this MCQ very well, so that we can move to the next. Next one is the case scenario, which includes your residential status as well as house property also, and your scope of total income. Everything is covered in this case scenario.
Here, this will tell you how important it is to know to determine the residential status first. Okay. And what will happen if you proceed to answer the question without determining the residential status of person? Ananya Gupta, a citizen of India. These things you keep in mind. That's why I'm circling it. Lives with a family in New York since the year 2000. So for the last 23 years, she's been living there. She visited India. Again, visited. From 21st March 2022 to 28th September 2022 to take care of a ailing mother. In the last 4 years, she has been visiting India for 100 days every year to be with her mother. So, now what is a residential? She is a citizen of India, living outside India. She is visiting India. Okay, now, of course, and what is the number of days of her stay in India? March goes into the earlier previous year. So earlier previous year that she has given 100 days every year to be with her mother. Now this one, current year, how long she has been in India? The current year it starts from April to 1st April to 28th September 22. That is the current previous year. So April में 30 days, May 31, June 30, July 31, August 31, September 28. So 8 plus 3, 11, carry 1, 3 5s are 15 plus 1, 16
180.
plus 2, 18, 181 days. She stayed in India for 181 days. Okay. Last, every year she's visiting India for 100 days, for 400 days. So we have to go ahead and find what her income. She's residing outside India. She's coming to India on a visit. She's an Indian citizen. And she has not, her stay in India is not 182 days, but it's greater than.
Dipanshu, hope it screen is visible now, because you have mentioned that screen is not clearly visible. I hope it's not okay now.
I think your question, Naman, is in case salary was received from Government of Australia. Na? It cannot be from by Government of Australia. I suppose you want to say received from Government of Australia. And if that person is residing outside India and is receiving from Government of Australia, then and is a non-resident, basically then it will not be taxable in India.
It's a foreign source income.
Foreign source income then. I think you want to say received by, you've written, but I think you want to say received from. Okay, now coming to this question now. We just switched off. So here, there are two things now. It will depend whether the 182 days he is not here. She is not here, sorry, Ananya Gupta. She's here for only 181 days. If her total income other than income from foreign sources is greater than 15 lakh, then you have to see the 120 plus 365 days condition, which she satisfies. Okay, so that is important. That we'll have to go and see what is her total income, excluding income from foreign sources. Chalo, let's go and see that. Only then we'll be able to find out her residential status. In this case, otherwise we won't be able to find out. We have to compute the total income also. Okay, she owns an apartment at New York, which is used as her residence. The expected rent of the house is $32,000 per annum. Value of $1 may be taken at 75. Municipal tax paid in New York in January 23 is 2,000. This will be relevant. When will this information be relevant? This information will be relevant if she turns out to be a resident and ordinarily resident. Only then this information will be relevant. In this case, it's not possible. Basically, why? It's not possible. This information is not relevant. It's an income from a foreign source, basically. And because for in computing total income, excluding income from foreign sources also, this will be excluded. This will not be considered for that purpose. Okay. Now, otherwise also it will not be considered, because if a person is an RNOR, she can, by default, if she satisfies the second condition, 181 days condition, she doesn't satisfy second condition, she will by default be an RNOR. In case of an RNOR also, this income will not be considered. I hope that is clear. She's a non-resident anyway, it won't be considered. Even if she's an RNOR, it will not be considered. It will be considered only if it's an ROR, which is not possible. From the information given, it's not possible that she's an RNOR. She took ownership and possession of a house in New Delhi on 25th March 2020. It's for self-occupation. Okay. So the municipal value is given, fair value is given. Then in case of a self-occupied house property, the annual value is nil. You need not see municipal valuation, fair valuation. It's not a, it's, so as of now, they've mentioned only about one house. So it cannot be a deemed let out house property. Anyway, two houses you can treat as self-occupied. So anyway, none of these things are relevant. It's a self-occupied property. What is relevant in this case? She had taken a loan of 16 lakhs at 10% from ICAI Bank on 1st April 2018 for constructing this house, and the construction got completed on 20th March 2022. No amount has been paid towards principal repayment. The house, she was there up to 28th September. Then afterwards, the house is vacant for the rest of the year. They're telling, so she's not let out the house. So it's obviously a self-occupied property. So in case of self-occupied property, the only deduction which is allowable is interest on borrowed capital, and that to the maximum interest which is allowable is 2 lakh. And that includes the pre-construction interest also. Current year interest is 16 lakh into 10%, 1,60,000, because nothing has been repaid so far. Pre-construction interest is what? From 1st April 2018 till 31st March 2021. Because in 2022, the construction is completed. So that year interest, 2021-22 interest, they can claim in that year itself. That is not pre-construction interest. The year in which the construction is completed, you go to the immediately preceding year, 31st March, till that time only it's your pre-construction interest. For 2021-22, in that year itself, should have been eligible for 1,60,000. So 1st April 2018 to 31st March 2021. So it's a period of 3 years. So 1,60,000 into 3. 60,000 into 3 is 4,80,000, which you have to, this is the pre-construction interest. This is available for a period of 5 years from 2021-22. Okay, so this will come to 96,000. This will come to 96,000 pre-construction interest. So current year interest is 1,60,000. Pre-construction interest is 96,000. So totally it comes to 2,56,000. But because it's a self-occupied property, I have to restrict it to 2 lakh. So 2 lakh will be the loss from this Delhi property. Okay. Then she had a house property in Mumbai, which was sold by her on 28 March 2022. In respect of this house, she received arrears of rent of 3 lakh on 4th February 2023. That is current year she is receiving. The amount has not been charged to tax earlier. So as per section 25A, arrears of rent is chargeable in the year of receipt, 3 lakh, after providing deduction at 30%. So 30% deduction will come amount to 90,000, 30% of 3 lakh. So that will be 2,10,000. It's chargeable as income from house property of the current year. 2,10,000 is the income from house property in Mumbai, and Delhi house property ke liye loss is 2 lakh. So the net income is 10,000. Okay. She does not have any other income from any other source during the previous year. She does not want to opt for the new tax regime under 115 BAC. So what is her income for the current year from Indian sources? It's 10,000. 2,10,000 from Mumbai house property and 2 lakh loss from Delhi house. So 2,10,000 minus 2 lakh is 10,000, which is our only income source. Since 10,000 is less than 1,50,000, because this residential apartment in USA is anyway a self-occupied apartment. It should not be taken into consideration because it's a foreign source. Even if it had been let out, you don't take it into consideration because it's a foreign source income. So for computing total income other than income from foreign sources, for her will be 10,000. This 10,000 is less than 1,50,000. So what condition for residential status you have to apply in her case? Now I want the answer from Dipanshu, Naman. In Ananya's case, her total income from Indian sources is 10,000. 2,10,000 minus 2 lakh, it is 10,000. 10,000 is her income, which is less than 1,50,000. She stays outside India. She has current year stay is 181 days. Current year she's in India for 181 days. Last 4 years she's been in India for 400 days. Which condition to apply? Naman, Dipanshu. I want it from you because 3 questions we've done on residential status. Her current year total income other than income from foreign sources is 10,000. She is an Indian citizen living outside India. She comes on a visit to India. Current year her stay in India is 181 days. Previous 4 years her stay in India for 400 days. What condition will be applicable for Ananya Gupta to determine her residential
There
status?
are 3 conditions, students. One is 182 days, second one is 60 plus 365 days, and the third one is 120 plus 365 days. So which condition will be seen in this current situation? Only 122 or 60 plus 365 or 182 or 120 plus 365? Answer, students, ki which conditions will be applicable to Ananya in this case?
Her total income is 10,000. I hope you're clear. Her total income other than income from foreign sources. Income from foreign sources is an apartment in USA where she's staying. That we exclude. That's income from foreign sources. Indian source mein she has a Delhi house property from which there's a loss. Because it's a self-occupied property, there's a loss of 2 lakh, which is basically interest. From Mumbai house property, the arrears of rent 3 lakh minus 30% will give you 2 lakh 10,000. So the net income is 10,000. She does not have any other source of income. 10,000 is her income from Indian sources. Now, what is her condition? Bhumika, you are right. 182 days condition will be applicable in her case. 120,365 will not be applicable because her total income is less than 15 lakh. Total income, excluding income from foreign sources, is less than 15 lakh. It's only 10,000 rupees. So only the 182 days condition will have to be seen for determining her residential status. Since she has stayed in India for only 181 days. It's only 1 day lower, but you can't see the 120,365, even though she satisfies that condition is not applicable to her because her income, total income excluding income from foreign sources, is only 10,000 rupees. Good, Bhumika. I hope it's clear for everyone. Naman, Deepanshu, Harini, and all the others. So in her case, she is a non-resident. And how this is going to see, for determining whether she's a resident or non-resident, I needed to compute her total income. I could not straight away come because whether to apply the 120, she would have satisfied the 120 plus 365 day condition. But had her total income been greater than 15 lakh, then she would have satisfied the 120 plus 365 day condition, and then she would have been a resident but not ordinarily resident. Get it? Then should have been, her residential status would have been resident but not ordinarily resident. She could have never been an R and OR in this particular case because of the conditions. Yes, Bhumika, you're right. Only 120. Naman Dingra, good. Yeah. Income is less than 15. Dipanshu, good. So it's very clear. So in this question, the first MCQ you can't answer by just solving on the basis of number of days. I have to first compute the entire total income of Ananya Gupta to answer whether she's a resident, not non-resident, or resident but not ordinarily resident. Fine. 1 second, let me see whether she lives in New York. Okay. Here, it is not given. In New York, everyone pays taxes, so 61A will anyway not be applicable. Even if 61A was applicable in her case, because her total income is less than 15 lakh, anyway it would have applied to her. But in this case, anyway, they have not given that she does not pay tax in New York or anything of that sort. Dubai, basically, you get a lot of exemption, Dubai or UAE countries. No? So there you have to be, if it's a country in UAE, you have to be very careful about the applicability of 61A. Okay. Now, Ananya Gupta, all the other things you will probably know. Ananya Gupta can claim nil annual value under 23(2) in respect of which of the answers are right. Here again, I want your answer. Her Delhi house. Sorry. Ananya Gupta can claim the benefit of nil annual value under 1023. See, in respect of Delhi house, option A. Option B, her New York house, since it's more beneficial, her Delhi house will be deemed to be let out. Expected rent would be the annual value. Her Delhi house alone, her New York house will be deemed to be let out and expected rent would be the annual value. Both her Delhi house and the New York house, since benefit of nil annual value under 23(2) is available in respect of 2 house properties. What is the correct answer? Here again, I want you people to answer. Think very carefully before you answer this question. Ananya Gupta can claim the benefit of nil annual value under section 23(2) in respect of 4 options are given. Delhi house, New York house, second one. Delhi house will be deemed to be let out. Then Delhi house alone, New York house will be deemed to be let out. As third one has says that New York house will be deemed to be let out and expected rent would be the annual value. Fourth one is both the Delhi and New York house. Dipanshu, self-occupied, both are self-occupied. You tell me clearly. Option A, B, C.
Option A, B, C, D. That is the correct option.
Fast. Which one? Bhumika, whether it's option A or Delhi house you're telling, but it's option A or option C then. Which one? Option, which option is the correct option? As of now, Delhi house is also self-occupied. New York house is also self-occupied. New York house is also not let up. It's self-occupied. And you can claim the benefit of two house properties as per 23(2). Two house properties. Tell me now what is the answer. Naman, Bhumika, Dipanshu. A, B, C or D? A. Bhumika says A. Anybody has a different opinion? Bhumika says A. Dipanshu, Naman. What about the others who are listening? Others can also answer because these three names are visible. We are telling these three names. I know there's one Harini here. If you scroll up, you'll see other names also, but I want everyone to be very participative. Give your answers quickly so that we can assess how much you've understood. Ma'am, option D. Naman Dhingra is saying option D. Then Dipanshu, what according to you? Dipanshu. Harini, you can also write what option? I'll explain it to you, what the correct option is and what is the reasoning. I'll give you one clue. One clue I'll give you, keep in mind the residential status. Keep in mind Ananya's residential status while answering this question. That's where the trick lies. See, I've given you. Naman says option D again. Naman says D. Dipanshu, I'm asking others. Okay, let me now say. Bhumika says A and Naman says D. Okay, in the normal case, as per section 1023(2), 23(2), section 23(2), I'm sorry, it's not 1023(2), section 23(2) says the benefit of nil annual value is available in respect of two house properties. Now she has two house properties, Ananya. She has a Delhi house, she has a New York house. Both are self-occupied. Can she claim the benefit in respect of both? Durga says C. Durga says option C. Delhi house alone, New York house will be deemed to be let out. Okay. Now what? Actually, you can, as per the provision, you can claim benefit in respect of two self-occupied properties. In this case, Delhi is also self-occupied, New York is also self-occupied. Okay, all that is very fine. But Ananya Gupta is a non-resident. This is important. This will change the answer. Had she been a resident and ordinarily resident, then your answer would have been D. Had she been a resident and ordinarily resident. But in this case, she is a non-resident. In case of a non-resident, the US property is not included in the scope of your total income. Excluded. It doesn't enter into the scope of your total income for you to exclude it. See, what do I give exemption? Something which is going to form part of your total income. Then thereafter, you provide exemption in respect to 23(2). Na? First of all, it should come within the scope of your chargeability provision. She is a non-resident. Non-resident is chargeable in respect of income which accrues or arises in India, income which is deemed to accrue or arise in India, income which is received in India. Okay. In respect of a US property, it's self-occupied. It's a self-occupied property. But why would she claim nil? Because it's not included in the scope of my total income. Income accruing or arising outside India is included in the scope of income only of a resident and ordinarily resident. In this case, Ananya Gupta is a non-resident. So a foreign property and foreign source of income is excluded. So the New York property is excluded from the source of total income. So 23(2) benefit she can claim in respect of her Delhi house. Okay. So this cannot be right because New York property does not form. You don't need to claim 23(2) benefit. By virtue of being a non-resident, it's not included within the scope of your total income. Fine. by virtue of being a non-resident. Had she been an R&OR, then you can say, yeah, Delhi house and New York house, because everything is included. R&OR means everything is included within the scope of your total income. Then 23(2) benefit you can claim in respect of Delhi and New York house. But she's a non-resident. New York house is anyway excluded within the scope from the scope of total income. So in respect of A, Delhi house, she can claim a 23(2) benefit. Why this is not right? C is not right. Here also it says Delhi house alone. Her New York house will be deemed to be let out and expected rent would be the annual value. No, New York house is not included within the scope of total. Second part of the answer becomes wrong in C. That's why C is not a correct answer. A is the correct answer. Her Delhi house. Bhumika is right. Okay. Now you've understood, Naman, Dipanshu and Durga. Why your Dipanshu and Naman says D. D would have been right if Ananya Gupta was an R&OR and her global income was taxable. If everything is taxable, then by virtue of 23(2), you will exclude Delhi and New York. But she is not an R&OR. She is a non-resident. That's where residential status plays an important role in answering the question. I hope you've understood, Naman, Dipanshu and Durga. Please. The remaining questions we've already answered. What is the income chargeable under the head income from house property? It is 10,000. We've already computed that. Okay. We needed to compute that for determining the residential status. Okay. Good. Naman has understood and Dipanshu also says he's understood. Now that, assuming that for the purpose of this question alone, Ananya Gupta has let out her flat in New York during the 6 months, April to September. When she was in India, she let out that flat for a sum of $6,000 per month. Such rent was received in her bank account in New York and then remitted to India through the approved banking channels. What would be the income from house property? See, Ananya Gupta is anyway a non-resident. Her residential status is not changing. She's a non-resident. Okay, so in case of a non-resident, the income which is received in India, income which accrues or arises in India is only taxable, deemed to accrue or arise. She has, in this case, the rental income is accruing or arising outside India. It was also received in bank account in New York. Receipt was also outside India. Subsequent remittance to India is not considered as receipt. Remember that. First point of receipt, she was received it in a bank account in New York. So it is an income which is earning outside India. So it's excluded from the scope of total income. So your answer is not going to change in this case. The answer will continue to be 10,000. Hope this is very clear to everyone. Bhumika, Naman, Dipanshu, Durga. Answer is not going to change because her residential status is not changing. Fine? Yes, Naman, it's a correct. I suppose now we go to profits and gains of business and profession. Presumptive tax provisions under 44 AD, once again a very important provision.
Okay, so your next MCQ is based on presumptive taxation under section 44 AD. So what is the MCQ? Mr. A, an eligible assessee. It's already given that he is an eligible assessee following mercantile system of accounting carried on eligible business. So it is already mentioned that he is carrying on eligible business under section 44 AD. So some details have been provided that his total turnover for the current previous year is 130 lakh. Then out of that 130 lakh, he has received some amount by way of account paycheck, by cash, by account pay bank draft, and some amount he has not received. So what is the requirement of the question in that? So the question asks, what shall be the amount of deemed profit of Mr. A under section 44 AD subsection 1 for assessment year 23-24. So what the 44 AD says? 44 AD says that if an eligible assessee, which Mr. A is already eligible assessee is given, carrying on some eligible business, then carrying on some eligible business, then his profit and gains from such eligible business would be 8% of his total turnover or gross receipt. So that 8% of total turnover or gross receipt shall be deemed to be his profit and gains from such eligible business. But this 8%, it will be considered as a 6% in case he has received the total turnover by some specific modes. What are the specific modes? If he has received it by account pay check, account pay bank draft, ECS by way of ECS, and some other prescribed mode. What are the other prescribed mode? They have been already prescribed. The prescribed mode, like if it's by UPI, by debit card, or by credit card, etc. So if then the eligible assessee has received his total his turnover or gross receipt, but by way of account pay check, account pay bank draft, ECS, UPI, etc., that other notified modes, then 6% of that sum would be the would be deemed to be the profit and gains from some such eligible business, and for other it will be 8%. So this 6% regarding that the turnover which he is received from the specified modes, that has to be received during the previous year or before the due date specified under section 139(1). If the turnover or sales or gross receipt amount is received by these modes during the previous year or before due date under section 139(1), then you have to take 6%. Otherwise, for the remaining turnover, you have to take 8% to be the profit and gains from the eligible business. So in this question, Mr. A's turnover is 138 lakh. Okay, and he is getting out of this turnover 25 lakh amount he has received from by account pay check in the current previous year itself, that is previous year financial year 22-23. Then 50 lakh he has received by way of cash. Then 25 lakh he has received by way of account pay check, and which he has received before the due date, and remaining 30 lakh he has not received till the date of filing of return. Suppose this information is not given, then you have to check that whether the total is getting matched to the total turnover. In this question, it is already given. What is given? 25 lakh is received by account pay, 50 by cash, 25 by account pay check. So if you total it, that it comes to 1 crore. So if this information is not given in the question, then remaining 30 lakh you have to assume that it is not received till date, and you because it has not received, it will automatically classify under 8%. So what will be the two parts of the income which is received by account pay check and the account pay bank draft? They would be qualify for 6%, and the remaining out of 130 lakh, the remaining 130 lakh, 50 lakh has been received by account pay check and account pay bank draft. So the remaining 80 lakh that will be qualify for 8%. Mr. A from this eligible business. What will be the 6% amount on the sales total turnover, and what will be the 8%? Naman has already answered it as B, but how, Naman? You have to just give that on which portion you have to compute 8% and for which portion you have to give 6%, compute 6%. There are 2%, 8 for presumptive, it's 6% and 8%. Out of the total turnover of 130 lakh, you have to first classify for which turnover amount you have to compute 6% profit and for which you have to compute 8%. So firstly, student, just answer me for 6%. What all the turnover amounts will be taken for 6%? The turnover which you have received by way of account pay check, account pay bank draft, ECS, and other prescribed mode like debit card, credit card, UPI, that will be qualified for 6%. In this case, there are two types of income which is received by way of account pay check and account pay bank draft. First is this 25 lakh, and the second one is third one, this 25 lakh. So on the 50 lakh turnover, 6% will be your deemed profit and gains, which comes to 3 lakh. Regarding the remaining turnover, what is the remaining turnover? It's 80 lakh. The 8% will be the deemed profit and gains from the eligible business, which comes to 6.6 lakh 40,000. It means So 6.4 lakhs. So the total profit and gains of Mr. A from the eligible business would be 9.4 lakhs under section 44 AD, which would be the deemed profit and gains under section 44 AD, because nothing is mentioned ki which what amount he is claiming. So the deemed profit and gains would be the 9.4 lakhs, which is the 6% of 50 lakh, and for the remaining 80 lakh it is 8%.
Chetan is written correctly.
Chetan is written correctly, 6%. Then Durga also mentioned D. Bhumika, yes, received through account pay check and received by account pay bank draft also. Yes, Naman, for 50 lakh it's 8%, but not for 50 lakh. 50 lakh for 6% it's right, but for 50 lakh it's not 8%, because remaining 30 lakh which you have
Rabi
not
means this 50 lakh.
because remaining 30 lakh which you have not received so far,
also
you have to pay. Because you have to pay, you have to assume the profit also on that. You have to pay tax on that also. So for the remaining 30 lakh which you have not received so far, you have to assume it under the 8%, because 8% is for overall. That 8%, then the 6% benefit is there only for if you have received the amount by way of these 4 modes during the previous year or on or before the due date under section 139.
See, it's given now he's following mercantile system of accounting. So you have to take what he's received after the due date for filing return. So he's following mercantile system of accounting.
So for, I guess Naman has mentioned 50 lakh, this 50 lakh for 8%, but this 30 lakh, you have to consider this 30 lakh also for 8%.
Deepanshu, you've asked, I think relating to the earlier question, if she is RNOR, then remittance amount can be included. Subsequent remittance you don't consider at all. Whether it's RNOR or non-resident, received outside India and subsequent remittance is not considered. It's not considered as receipt. Subsequent remittance is not considered, irrespective of whether she is non-resident or RNOR. In fact, in that particular question, even if her residential status had turned out to be RNOR, her total income would have remained 10,000 only. That would not have changed in that particular question, because there was nothing like income from a business controlled from a profession set up in India in that question. In which case, there would be a difference between non-resident and not ordinarily resident. But anyway, you have to determine the residential status correctly. Probably your other questions answers would have been right, but in that first question, you have to determine the residential status correctly. You can't, she's a non-resident in this question. Even though if she was a not ordinarily resident also, her income would have remained the same.
Yes, Dipanshu, for 50 lakh it's 6% and for remaining 80 lakh it's 8%. Okay, so the correct answer is D, 9.4 lakh for this. So the next question is on capital gain.
These provisions relating to presumptive taxation are very important. 44 AD, ADA, 44 AE, they're all given in a very tabular form in your study material. What is the rate to be applied? What is the threshold limit of turnover in each case? What other deductions should not be available? Go through the PGBP chapter. By way of a chart, it's explained very clearly. In one glance, you'll be able to understand the whole thing, and they are very important from the exam point of view also.
So the next question is on capital gain. I'll just start with this question. Mr. Vishal and Mr. Guha sold their residential house property in Pune for 3 crore and 5 crore. So respectively in January 2023. The house property was purchased by them 25 months back. So if the house property is purchased by 25 months back, then it will be a long-term capital asset, because the house property, the land or building or both, it is held for more than 24 months before the date of transfer. So it will be qualified as a long-term capital asset, because it is held for more than 24 months. Okay, the index cost of acquisition, because it's a long-term capital asset, then indexation benefit will be available to Mr. Vishal and Guha as well. And already in the MCQ, it's given that index cost of acquisition is 1 crore and 1.75 crore respectively for Vishal and Guha. So in case of Vishal, What is the full value of consideration? It's 3 crore. And what is the index cost of acquisition? It's 1 crore. So his long-term capital gain would be 2 crore. In case of Guha, the full value of consideration would be 4 crore and the index cost of acquisition, which is already given in the question, is 1.75 crore. So the long-term capital gain is 2.25 crore. Now, Mr. Vishal purchased two residential flats, one in Delhi and one in Agra, for 70 lakhs and 50 lakhs respectively. And 70 lakhs property in Delhi and 80 lakhs property in Agra in April 2023. On the same date, it means in April 2023 itself, Mr. Guha also purchased two residential flats, one in Mumbai and one in Pune, for 80 lakhs and 75 lakhs respectively. So now what they have done, after this long-term capital gain, they have sold this residential house property. They have invested in the two residential flats, Delhi and Agra, and another one in Mumbai and Pune. So what will come into that picture? That exemption under section 54. What the exemption under section 54 says, ki if the assessee, if the individual has sold their residential house property from and the residential house and is having a long-term capital gain, it is available only if in case of long-term capital asset. And he is purchasing, the assessee is purchasing 1 year before, in case of purchase 1 year before the date of transfer, or and 2 years after the date of transfer, or in case of construction, if you construct some property within 3 years after the date of transfer, then he will get the exemption under section 54, and only in respect of one residential house property in India. So the house property should be in India and only in respect of only one residential house. But there is a proviso that if the assessee, the individual is not the capital gain which the individual is arising from the transfer of the residential house, which is a long-term capital asset, and the capital gain on that asset is not exceeding 2 crore, then he has an option to claim the benefit of section 54 in respect of purchasing two residential house property, which was originally for one residential house property. That it means that you can purchase or construct one residential house property in India after having the capital gain, and you will get the exemption. But in case your capital gain doesn't exceed 2 crore, then you have an option to purchase or construct two residential house property in India, and this is a one-time option only. In the lifetime of an assessee can claim this option of claiming exemption for two residential house property only in one time. So in this case, what is the in case of Mr. Vishal is having the long-term capital gain of 2 crore. So he is eligible for claiming the exemption under section 54 in respect of two residential house property. While in case of Mr. Guha, his capital gain exceeds 2 crore, so he doesn't have this option. He can claim exemption under section 54 only in respect of one residential house property in India. And the condition if of 1 year before, purchase of 1 year before and 2 year after is already met there, because they have sold their property in January 2023 and purchased the property in April 2023, that is within the time frame of 2 years after the date of transfer. So what happened in case of Mr. Vishal has invested 70 lakh for for a residential flat in Delhi and 80 lakhs for residential flat in Agra. So he can claim the exemption for both the residential house property for both the residential house property would be 1.5 crore. And For Mr. Guha has also purchased 2 residential flats, one in Mumbai for 80 lakh and one in Pune for 75 lakh. But he doesn't have that option. So he can claim exemption only in respect of one residential house. Obviously, it's beneficial to claim exemption in respect of Mumbai house, because for that he will get the exemption of 80 lakh instead of the Pune house of 70 lakh. So the exemption under section 54 for Mr. Guha will be of 80 lakhs. Okay, then what they have done, they both of them invested rupees 30 lakh in bonds of NHAI in March 23 and 30 lakhs in bond of RECL in April 2023. Now there is another exemption comes in the picture. An exemption, what is the exemption? That exemption is under section 54 EC. 54 EC exemption is also available in respect of long-term capital asset only. So if you have a long-term capital gain, then only you can claim exemption under section 54 EC. And in respect of the asset will be of your land or building or both. So in this case, since your asset was the residential house property, qualify for exemption under section 54 EC. What the exemption says is, if you have invested the amount in bonds of NHAI or RECL or PFC or RIFC, then you will get the exemption under section 54 EC, and the maximum exemption under section 54 EC would be 50 lakhs, whether in the current previous year or in the subsequent year, and you have to invest in these bonds within 6 months from the date of transfer. So in this case, when the property was transferred in January 2023. So Mr. Vishal and Mr. Guha have the time limit till July 23. So they can invest in the bonds of NHAI or RECL up to July 23. But they have invested in March 23 and April 23. Okay. So they have invested 30 lakh in NHAI and 30 lakh in RECL. So they have invested 60 lakh. But the maximum exemption under section 54, you have to restrict it to 50 lakhs. They can get the exemption under section 54 EC for 50 lakh only. So now Mr. Vishal will get the exemption under section 54 EC of another 50 lakh. And similarly, Mr. Guha will also get the exemption under section 54 EC of 50 lakhs. So what would be the capital gain of Mr. Vishal? Mr. Vishal has a capital gain of 2 crore, but he has got the exemption under section 54 for 2 residential house property and another exemption under section 54 EC for investing in the bonds of NHAI and RECL or rupees 50 lakhs. So his capital gain would be nil. And regarding Mr. Guha has long-term capital gain of 2.25 crore, but since his capital gain exceeds 2 crore, he doesn't have that option of claiming exemption under section 54 in respect of 2 house property. So he has the exemption only up to 80 lakh, which is for the 1 residential house property, which is beneficial for him regarding the Mumbai house. Then he also got the another exemption under section 54 EC of rupees 50 lakh, which is a maximum permissible exemption under section 54 EC. So now he will, his capital gain would be your 95 lakh, which is chargeable to tax after claiming all the exemptions. So what was the requirement of the question? That what is the income taxable under the head capital gains for assessment year 23-24 in the hands of Mr. Vishal and Mr. Guha? So first option was 70 lakh and 95 lakh. This is not the correct option. This first option was the correct option if we have not claimed the exemption for Delhi house. But since Mr. Vishal's long-term capital gain doesn't exceed 2 crore, he has the option of claiming exemption in respect of 2 residential house. So it's beneficial that he claims the exemption for both the house property, both the residential flats. So A is not the correct option. Then B, 60 lakhs and 85 lakh, which is also not the correct option, because the maximum exemption under section 54 EC which they can claim, that is 50 lakh, not the 60 lakh. Then another option is C, which is the correct option, nil in case of Mr. Vishal and 95 lakhs in case of Mr. Guha. And the D, nil, next option is nil in case of Mr. Vishal and 20 lakhs in case of Mr. Guha, which is also not a correct option, because Mr. Guha cannot take the benefit of claiming exemption under section 54 in respect of 2 residential house property, because his capital gain exceeds 2 crore. So that beneficial provision is not applicable for Mr. Guha. So the correct answer will be C. I hope students it's clear. Yes, Chetan.
Written the correct answers.
Naman, yeah, Vishal nil and Guha 95 lakhs. Chetan, yeah, right, it's C. Durga also, she understood well, C. Bhumika, I hope you also understood this. So, okay, next, I'll just go to the next MCQ then, because I guess it's very much clear to all the students. Next is on other sources. It's in respect of dividend. So what it says, Mr. X, age 61 years, earned dividend of rupees 12 lakh from ABC Limited in previous year 22-23. Interest on loan taken for the purpose of investment in this shares is 3 lakh. So the income includable in the hands of Mr. X for the previous year 22-23 would be, okay. Dividend is anyhow taxable now in the hands of shareholders. There is no there is no exemption, there is no DDT. So dividend is very much taxable in the hands of Mr. X. So dividend which is taxable under the head other sources is 12 lakh. What about this 3 lakh, which Mr. Hasan incurred because he has taken a loan to invest in the shares of ABC Limited, from that which he got the dividend amount. What about this expenditure, this interest expenditure? Under section 57, permissible deductions are provided, that what kind of deduction you can claim from the income you are earning under the head income from other sources. In this respect, there is a proviso to section 57 which says that if in case of a income which is by way of dividend, income in respect of units of a mutual fund, units of a mutual fund, or income in respect of units of a specified company, no deduction will be allowed other than the deduction in respect of the interest for earning such income. But there is a condition that the interest expenditure which is allowed in respect of this earning this income, that expenditure would be allowed only to the extent of 20% of such income. It means you will get the deduction in respect of the interest which you are paying for earning this dividend income, but the maximum permissible deduction would be 20% of such income. So if you are earning the dividend of 12 lakh, deduction in respect of this interest which you are paying would be allowed only up to 20% of this 12 lakh, which will be your 2,40,000. However, in this case, Mr. Hasan incurred 3 lakh interest expenditure, but the maximum deduction you will get, that is 20% of such income which you have earned. So you will get only 2,40,000 deduction. So what will be the taxable dividend in the hands of Mr. X? That will be 9,60,000, which is the B is the correct answer. I hope this is clear. In case of dividend, in case of income in respect of units of mutual fund, income in respect of units of specified company. No other deduction is allowed except this interest which you have incurred for earning such income. And only that is restricted up to 20% of such income. No remuneration, no commission, nothing is allowed in respect of this income. No brokerage, nothing. Only that interest expenditure is allowed, and which is also subject to condition of 20%. So I hope this MCQ is clear. Bhumika, Durga, you say C. If you must have reduced this 3 lakh to get this 9 lakh the answer, but which is wrong, because only up to 20% of the dividend income you can claim the expenditure in respect of interest. You can't claim more than 20%. However, you have incurred 3 lakh, but you can't claim the deduction of 3 lakh in this case. You have to restrict your deduction up to 20%. 20% of what? 20% of your dividend income. Yeah, Durga, it's right. 9,60,000. Bhumika also got understand this. So now I move to the next MCQ, which is on income regarding 56,210. Mr. Vikas received a gold ring worth rupees 60,000 on the occasion of his daughter's wedding from his best friend, Mr. Vishnu. Mr. Vishnu also gifted a gold chain to Kavya, daughter of Mr. Vikas, worth 80,000 on the said occasion. On the said occasion means on her marriage. So would such gift be taxable in the hands of Mr. Vikas and Ms. Kavya? Okay. Regarding this, what is the provision under section 56.210? 56.210 says, in respect of this, because it's about gold ring and gold chain, so it's a movable property. So in respect of movable property, if any person has received movable property from other person without consideration, because in this case it's a without consideration, and the aggregate fair market value of such movable properties exceed rupees 50,000, then the fair market value will be taxable in the hands of the recipient under section 56.210 under the head income from other sources. So in this case, what's happened? Mr. Vikas, he is also getting something, and Kavya, his daughter, she is also getting something. Vikas is getting gold ring worth rupees 60,000, and Vishnu is getting Kavya is getting gold chain worth rupees 80,000 from the same person, Mr. Vishnu. What up now? Occasion. There are some exceptions also under section 56.210, in which case the section 56.210 would not be applicable. What are the exceptions? There are 2-3 exceptions. The major exceptions, which one is if you have received gift or anything from your relative, which you have the amount, sum of money you have received on in a will or by inheritance, or on the occasion of marriage. There are many other exceptions also, like by charitable trust, to trust, holding to subsidiary company, and so on. So, but I'm talking about only these 3 exceptions. First is by from a relative, then second one by will or inheritance, or on the occasions of marriage. What was the occasion in this case? In this case, the occasion was Mr. Vikas' daughter wedding. And who is his daughter? It's Mr. She is Mr. Who is his daughter? Miss Kavya. So Mr. Kavya got a gold chain from Mr. Vishnu on her marriage, on the occasion of her marriage, and Mr. Vikas got on the occasion of his daughter marriage. So what will be the taxability in case? I just want the answer from you students, ki in whose hands that the gold chain and the gold ring will be taxable, in the hands of Mr. Vikas only, or in the hands of Miss Kavya only, or in both of them hands this gold chain and gold ring will be taxable. Miss Durga, you are saying taxable, but in whose hand? Mr. Vikas ke hand pe it's taxable, or Miss Kavya, or both? Because they both are getting something from Vishnu. Mr. Vikas is getting gold ring of 60,000 and Kavya is getting gold chain of 80,000. Bhumika, it's C. Bhumika is saying C. Well,
Bhumika, I think, said C for the earlier answer. For the earlier one, she wrongly typed B.
Okay,
for
okay.
This one, strongly typed C.
Durga is saying taxable. Durga, I want clarity for taxable in whose hand. I'll just read out the option. So you just tell me which option. Option A says gift of gold ring and gold chain is taxable in the hands of Vikas and Kavya respectively. It means it's taxable in both the hands. Gift are not taxable in the hands of Kavya nor in the hands of not taxable in the hands of Vikas nor in the hands of Kavya. It means in both of them hands there will be exemption. C says value of gold ring is taxable in the hands of Vikas, but value of gold chain is not taxable in the hands of Miss Kavya. D says value of gold chain is taxable in hands of Miss Kavya, but value of gold ring is not taxable in the hands of Mr. Vikas. Firstly, tell me, is there any exemptions applicable to Mr. Vikas or Kavya or not? Bhumika, in case of Vikas, it is taxable, but in case of Kamya, it is exempted. Dipanshu, on the occasion of marriage, total income in the hands of Kavya is fully exempt. Okay, Bhumika, okay. Durga says A. Durga says gift of gold ring and gold chain is taxable in the hands of Vikas and Kavya respectively. Naman says option A. Naman and Durga says option A, and as of now Bhumika says option C, I guess, and Dipanshu also option C. Okay, I'll just brief you what is the case. This is the case of marriage of Miss Kavya. So it falls under the exception when she receives something from a person because it's her marriage. So if she is getting anything, gold chain, gold ring or something from Vishnu or XYZ, it is exempted, and the provision under section 56 210 is not applicable on her because she is getting on the occasion of her marriage. So this 80,000 would not be taxable in the hands of Miss Kavya. On the other hand, Vikas will not get any exemption, or that will be not excluded in the hands of Mr. Vikas because he is not getting on the occasion of is getting on the occasion of his daughter wedding. So there is no exceptions for your daughter or son's marriage. Exception is only in respect of your own marriage if you are getting something. So, and since the aggregate fair market value of Moola property exceeds rupees 50,000, it is taxable in the hands of Mr. Vikas. Whole 60,000 would be taxable. There is no that exceeding amount above 50,000 is taxable. Whole 60,000 amount would be taxable in the hands of Mr. Vikas. So what would be the correct option? Correct option would be C. Value of gold ring is taxable in the hands of Mr. Vikas, but value of gold chain is not taxable in the hands of Miss Kavita. Yes, it's C. Chetan, you are also right. Kavya has exemption. Durga, there is exemption not because of the amount of 50,000, because Kavya, there is some exclusion from 56 to 10. One of the exclusion is if your person is getting on the occasion of marriage, on the occasion of his or her marriage, then 56 to 10 would not apply to them. So since Kavya's marriage and Kavya is getting a gold chain from Mr. Vishnu, so 56 to 10 would not be attracted in case of Miss Kavya.
See, if it's 50,000, less than 50,000, in any case, whether whatever occasion it is there, it will be exempt. But specifically, whether it's on the occasion of marriage, from a relative, under will, there are some exceptions which have been specified by a registered trust. In all those cases, irrespective of the amount, even if it becomes taxable by virtue of being more than 50,000, by virtue of these exclusions, they get excluded from the 56 to 10. But on the occasion of marriage is one such exclusion. But it should be your own marriage. It should not be your daughter's marriage, son's marriage, and all those things. Or it cannot be your 60th marriage or something. Your actual marriage when you're getting married. Sometimes the question they give you, it's for the Sashtiyatha Bhurti which you have at the age of 60, 60th marriage. That is not exempt from the purview. It's only the actual marriage and the person, the people, the couple who are getting married, the gifts is exempt in their hands. And in case of a relative, whatever, in case of a relative, that is at any point of time. Suppose it had been a brother or sister, suppose Mr. Vishnu had been a brother of Mr. Vikas, then this would have been exempt, even if it's not, whether or not in the occasion of marriage.
I hope Durga and Naman, you have understood that the correct option is C, not A, because it's not taxable in the hands of Kavya. No, Naman. There's two separate exemption, separate exclusion. If you are getting anything on the occasion of marriage, then also 56(2)(10) is not attracted, or you are getting from relative. So there is no combination. If you should be getting anything from relative on the occasion of marriage. If you are getting from your relative at any point of time, 56(2)(10) will not be applicable. So there is no condition if you are getting it from relative. In this case, Mr. Vishnu was a friend, is a friend of Mr. Vikas. He is not a relative. So I hope it's clear, Durga and Naman now, so that we can move to the next MCQ.
Before 9th and 10th are on clubbing provisions, I'll take the 10th one before 9th. Okay. Mr. Arvind gifted a house property to his wife, Mrs. Meena, and a flat to his daughter-in-law, Mrs. Sita. Both the properties were let out. So which of the following statements are correct? Income from both properties is to be included in the hands of Arvind by virtue of 64 clubbing provisions. Income from property to gift to wife alone is to be included in Mr. Arvind's hands by virtue of 64. Then Arvind is the deemed owner of house property gifted to Meena and Sita. Arvind is the deemed owner of house property. Arvind is the deemed owner of house property gifted to Meena, and income from property gifted to Sita will be included in his hands by virtue of 64. Okay. Now, 64 contains clubbing provisions. Okay. In that, it particularly states any asset which is transferred to income from an asset transferred to wife, otherwise than for adequate consideration, or in consideration of an agreement to live apart. If it's not for adequate consideration and it's not with an agreement to live apart, then the income from the asset which is transferred to wife will be included in the income of the husband. However, there's one exception other than house property. Why? Because in case of house property, section 27(1) contains the deeming provisions. Where a person transfers a house property to his wife or husband, spouse, or minor child. Okay? Minor child other than minor married daughter, then that person will be the deemed owner of house property, in which case the income from house property will be directly taxable in the hands of that person. Okay, so once it's directly taxable in my hands, there's no need to apply clubbing provisions again, because I'm the deemed owner of the house property which I'm transferring to spouse. So when I'm the deemed owner, it's anyway going to be taxable in my hands. There's no need to apply 64. But this is only in the case of house property, not other assets. For other assets transferred to spouse, 64 will apply. In case of house property alone, because the transferor spouse is deemed as the owner, 64 will not apply again. Okay, I hope this is clear. This is in respect of house property transferred to spouse and minor child. Okay, so Arvind gifted a house property to wife. Wife is spouse. So Arvind will be the deemed owner by virtue of 27(1), and income from house property will be assessed in the hands of Mr. Arvind, who is the deemed owner. So there's no need to apply 64 in the case of transfer of house property to wife. Okay, Meena. Then flat to his daughter-in-law, Sita. In daughter-in-law case may also clubbing provisions under 64(1)(4) will apply, whereby income from house property which is transferred to son's wife will be without consideration, without adequate consideration, will be included in the hands of the transferor. So here daughter-in-law, son's wife, so it will be included in the hands of Mr. Arvind by virtue of section 64. 64 will be attracted clubbing provision. That is, it will be assessed in the hands of Sita at the first instance. Then the income will be included in the income of Arvind by virtue of clubbing provisions under section 64. Whereas in the case of flat gifted to wife and you get the rental income from that flat, Arvind, it will be directly taxable in the hands of Arvind, who is the deemed owner. So what is the correct answer here? Correct answer is option D. Arvind is the deemed owner of property gifted to Meena. Meena is his wife. So 27(1) will apply and he is a deemed owner. Income from property gifted to Sita, who is his son's wife, will be included in his hands by virtue of section 64. It's very clear, na? For wife and son, for wife and minor child, other than minor married daughter, if you're gifting the house property, deeming provisions under 27(1) will apply. The transferor, spouse or transferor parent will be deemed as the owner. In respect of that part, clubbing provisions will not apply. But if you're transferring to son's wife, then section 64. Or if you're transferring any other asset other than house property to spouse, then 64 will apply. Other than house property, if I'm going to transfer any other asset to my spouse, then 64 clubbing provisions will apply. In this case, for daughter-in-law, in any case, clubbing provisions will apply because it's without adequate consideration. Is it very clear? Yes, all of them have given the right answer, Naman, Durga and Bhumika. This was a simpler one as compared to the earlier one, so I thought I'll take this. Okay. Now question 30. This is again on clubbing provisions. Mrs. Shivani, wife of Anurag, is a partner of a firm. Her capital contribution is 5 lakhs to the firm as on 1/4/2022, which includes 3.5 lakhs contributed out of gift received from Anurag. Anurag is her husband. Okay, so her total contribution as on 1/4/2022 is 5 lakh, out of which 3.5 lakhs is gift received from husband. Okay, and so what is the balance? 1.5 lakhs is her own. Firm paid interest on capital of 50,000 and share of profit of 60,000 during the financial year 22-23. The entire interest has been allowed as deduction in the hands of the firm. Okay. Now, which of the following statements are correct? Share of profit is exempt, but interest on capital is taxable in the hands of Mrs. Shivani. Share of profit is exempt, but interest of 39,286 is includable in the income of Anurag, and interest of 10,714 is includable in the income of Mrs. Shivani. Share of profit is exempt, but interest of 35,000 is includable in the income of Mr. Anurag, and interest of 50,000 is includable in the hands of Mrs. Shivani. Share of profit to the extent of 42,000 and interest on capital to the extent of 35,000 is includable in the hands of Mr. Anurag. So what are the provisions which we apply here? Here first it's a case of gift to transfer to spouse. In this case, he's transferred cash to spouse by way of, and she has invested in the business. So what happens in such a case? So if any, what is a general provision for clubbing? If you give anything to your spouse without adequate consideration or in consideration to live apart, then income from such asset is includable in the hands of the transferor spouse, in the hands of the husband. Okay, in the hands of Mr. Anurag in this case. Then if the wife, in this case, the wife has invested it as a capital in a firm. In that case, what? Interest receivable to that proportion to which it's made out of the gift received from the husband will be includable in the hands of the husband, because the wife has received a gift, okay, and she has invested it in business. She could, if she has invested in FD and earned interest on FD, the interest on FD will be includable in the hands of the husband. Now, she's invested that amount in the business. She's invested her own money also in the business. She's invested both her own money of 1.5 lakh, whatever her husband gifted of 3.5 lakh. Both she has invested, okay, on 1/4/2000. And the firm pays interest on capital. It gives you share of profits also. Okay, now share of profit is exempt under section 10. Share income from a firm is exempt under section 10. So exempt income ke case mein, there is no point in applying clubbing provisions. So that profit part of it you can ignore because it's anyway exempt. Interest on capital is 50,000. And they said entire interest has been allowed as deduction in the hands of the firm. So whenever anything has been allowed as deduction of the firm, that is taxable in the hands of the partner. So 50,000 is taxable in the hands of the partner. But 50,000 out, how did she earn the 50,000? 50,000 she is earned on a capital of 5 lakh. As on, you have to take it as on the first day of the previous year. What was the capital? That's what you have to consider. She's earned an income of 50,000 out of a capital of 5 lakh. Out of this 5 lakh, 3,50,000 is out of gift from husband. Okay. So only 1,50,000 is her own contribution. So that proportionate interest would be includable in the hands of Anurag. So what is the interest on capital? It's 50,000, which is taxable in the hands of the partner. How much did Anurag contribute? 3.5 lakh. Out of total, what 5 lakh? This I have to see on the first day of the previous year. If suppose after 1/4/2022, on 10/4/2002, again the husband had made some contribution. So that I will not take into consideration for this year. That I will take into consideration for next year. Because this year, as on 1/4/2002, the first day of the previous year, I'll have to consider. Okay. So 3.5, 50,000 into 35 by 50. Or 3.5 by 5, whatever you want to take. So 50,000, 1,000 into 35 is going to 35,000. 35,000 will be includable. Interest to the extent of 35,000 will be includable in the hands of Anurag. Which option will be right? Share of profit is exempt? Yes, right. So I need not bother about clubbing provisions. Interest of 35,000 is includable in the income of Mr. Anurag, and interest of 15,000. The remaining 15,000 will be includable in the income of Shivani. Is this clear? Is this clear? Because a husband has gifted money to his wife. So when you gift anything to your spouse without consideration or in connection with an agreement to live apart, then the income which you earn from that asset will be includable in the hands of the husband. It will be includable in the hands of the husband. Had she put it in FD, interest on FD would have been includable in the hands of the husband. In this case, she invested in her own business. 3.5 lakh which her husband gifted, she has put it in the business. 1.5 lakh, her own money also she's invested in business. By way of what? In a partnership firm, by way of capital contribution. So when she is invested by way of capital contribution, interest receivable from the firm. Share of profit of the firm is anyway exempt. Exempt income, you need not bother about clubbing provision. Interest receivable from the firm. So interest of 50,000 is received on a capital of 5 lakh. Out of that 5 lakh, 3.5 lakh is contribution by Anurag. So 3.5 lakh divided by 5 lakh into 50,000 will give you 35,000, which is to be included in Anurag's hands. Here we are taking the figure as on the first day of the previous year. This question does not contain any adjustments, but suppose they give you some capital contribution after the first day of the, even if it's on 2nd April, then also you don't include that. Suppose 2nd April, there is a, in this question, instead of this one, 2nd April, 3.5 lakh is invested, then thereafter is given another 1 lakh also. That 1 lakh you will not consider for allocating the current year's profit. You will consider for allocating the next year's profit, because on the first day of the next previous year, that proportion will be included. Because of that, for next year, you take it. For the current year, you cannot take. Current year, whatever was the capital contribution as on the first day, what is the amount gifted by the husband, and what is your own contribution, in that proportion you will have to consider. I hope this is clear to everyone. Clubbing provisions. This is also a very important provision. Share of profit, we are not in clubbing because it's in any case exempt. It's clear, na, everyone? Okay. Now, next one is on set off and carry forward, and Dimple will take that. But before that, I just want to tell you one thing, because we've talked so much about house property. I just want to give you some point relating to house property. See, in case of a loss from house property, there is a particular loss from house property for a particular year. So, in case of a self-occupied property, the interest is restricted to 2 lakh. Okay, so the maximum loss can be 2 lakh. In case of a let out property, there's no restriction of interest. So your loss, because of the interest deduction, you can have a loss of 4 lakh, 5 lakh also. Okay, that is permitted. There's no restriction under section 24 for that. However, against income from any other source, against salary income or income from any other source, I can set off in the current year only to the extent of 2 lakh. Okay. In set as the self-occupied property, anyway, it's only 2 lakh. Total, I get a loss only 2 lakh. So anyway, it won't be more. Even if it's 3 lakh, I'll have to restrict it to 2 lakh by virtue of 24. Whereas in case of a let out property, there is no restriction under 24. I can claim 5, 6, 10 lakh also. But what I can set off in the current year against some other income is only to the extent of 2 lakh. Remaining lakh, suppose it's 7 lakh. 2 lakh I can set off against salary income current year. 5 lakh I can carry it forward. Once I'm carrying forward the subsequent years against income from house property, you know now when you go to the subsequent year, then it becomes restricted. I can set it off only against income under the same head. Generally, there are some specific exemptions also. When next year I have an income from house property for 12 lakh, then there is no restriction. I can set off the entire remaining 5 lakhs against the income from house property of 12 lakh. There is no restriction. The restriction is regarding set off against any other heads of income. In this regard, 115 BAC is also important. 115 BAC says this is under the normal provision. So far, what I told you was under the normal provision. Suppose you apply 115 BAC. 115 BAC, there's a specific provision that loss from house property cannot be set off against any other income. Even you cannot set it off. Whether, I mean, if it's a let out property or a self-occupied property, any loss, you can't set it off against any other head of income, even in the same year. The 2 lakh restriction, that also doesn't apply. Even 1 rupee, you cannot set it off against any other head of income. This I thought I'll tell you before you commence, set off and carry.
So the next question is on set off and carry forward of losses. The details of income losses of Mr. Kumar for previous year 22-23 are as follows. He has some certain income from salary, which is already given as computed. Keep in mind, student, if it is written as it's already computed, you doesn't need to provide standard deduction again. But if salary is only written and there is nothing mentioned about regarding computation or salary received or something is written, then you have to compute the salary under the head salary. Then you have to provide standard deduction of rupees 50,000. But in this case, MCQ, it is already written as computed, so there is no need to provide standard deduction of 50,000 further. So he has an income salary of 5,20,000. He has certain loss from self-occupied property, let out house property, specified business, medical business. Then he has again a long-term capital gain of 1,60,000 and income from other sources of 80,000. So what is the requirement of the question? What shall be the gross total income of Mr. Kumar for assessment year 23-24? So firstly, we have to see what all the income he has. He has salary income. 5,20,000. Then long-term capital gain 1,60,000. Then income from other sources 80,000. Okay. Now regarding the losses, he has all of these losses. First loss is loss from house property. One is from self-occupied property and another is from self-occupied property. As ma'am has already told that in respect of self-occupied house property, the maximum loss which you can get, it's only 2 lakh. But in case of house property, there is no restriction. You can get loss even if more than 2 lakh. So the total loss under the house property is 3,20,000 in this case. But as per section 71(3)(a), in case you have a loss from house property and you have income under any other head, you can set off the loss from house property from that other income only to the extent of rupees 2 lakh. So you can't set it off the loss from any other head more than 2 lakh. You can have the loss from house property in case of let out more than 2 lakh, but you can't set it off against any other income. So you can set it off only up to 2 lakh. And you can set it off against your salary income, long-term capital gain and other sources. You can set it off against all the 3 income. So firstly, in the loss set off and carry forward, you have to see which is more beneficial for the assessee to set it off. You can set it off against long-term capital gain, salary, and other sources. But what is beneficial? Beneficial if we set it off against salary income or long-term capital gain. Because long-term capital gain is taxable at a special rate at 20%. In this case, it's not mentioned, it is under section 112A or 112. So normally we are assuming it is under section 112, which is taxable at the rate of 20%. So what are the other income he has? 5,20,000 and 80,000, which is 6 lakh. So it will be obviously chargeable at 20% above 5 lakh. But for the income up to 5 lakh, 5% below up to 2 lakh 50 to 5 lakh, it is taxable at 5%. But this 1,60,000 is straight taxable at 20%. So it is beneficial to set it against long-term capital gain because it is taxable at the rate 20% at flat rate. So this 2 lakh of house property, we can set it off against long-term capital gain up to 1,60,000 because we have long-term capital gain of rupees 1,60,000. Then remaining 40,000, you can set it off against salary income or other income from other sources. It doesn't matter because both are taxable at normal rate of tax, and there is no restriction of setting off the losses from salary or other sources. But there is another catch in this MCQ. What is this? If you see, there is a loss of medical business of rupees 1,20,000. As per section 71, if you have a loss from business, you can set it off against any other heads of income except salary. So this 1,20,000, you can't set it off against this 5,20,000. So what will happen in this case? If you set it off this house property loss from long-term capital gain, then you will not have this long-term capital gain income, and you will have only this other sources income of 40,000. So what will happen? You can set it off your business loss only to the extent of 40,000 here, and the remaining 80,000 you have to carry forward. Still, you have salary income, but because you have not planned take the manner in a most beneficial manner, you have not planned accordingly. So you have to carry forward the losses of 80,000 for the next year. So before that, it is very necessary to see which is the manner is most beneficial to the assessee. So in this case, firstly, we will set off the medical business losses from the long-term capital gain because there is a restriction that you can't set it off business loss against salary income. So firstly, we will set it off business loss of rupees 1,20,000 from this long-term capital gain. So what will you have? You have the 40,000 long-term capital gain, and remaining other sources income you have already have.
It's hanging.
It's hanging. For now, there is no restriction on house property. You can set it off against salary income or balance long-term capital gain or other sources. So you can set it off against long-term capital gain because it's taxable at 20% straight flat. So you can set it off house property loss 40,000 here. Then remaining salary, you can set it off against salary income because otherwise you have to bifurcate between other sources and salary. So remaining 1,60,000 because total 2 lakh only you can set it off. So balance house property loss of 1,60,000 you can set it off against salary income. So you will have 3,60,000 of salary income and 80,000 of other sources income. So your total income will be 4,40,000. In this case, what is the requirement of the question? The requirement of the question was the gross total income only. So there is no bifurcation key. You have to set it off against long-term capital gain other sources. But in the descriptive question, you have to see in the most beneficial manner because if you compute the tax liability in this case, definitely it will impact. If you don't set it off against long-term capital gain first, you have set it off against other sources, the medical business loss, then your tax liability might be higher in as what you are getting in this case. So while solving the descriptive question, you have to see very carefully that which is the most beneficial manner for the assessee. Regarding the specified business loss, because as per section 73A, the loss from specified business under section 35 AD, you can set it off that loss against only the profit and gains from the another specified business, which Mr. Kumar doesn't have in this current year. So this loss cannot be set it off against salary, long-term capital gain, or other sources income. This can be set it off only against income from profit and gains from another specified business. Or so there is no profit and gains from specified business, that it can be carry forward to set it off against next year, and there is no time limit for carry forward of losses from specified business. So what would be the correct answer in this case? The correct answer would be A, 4,40,000. Yes, Naman, the correct answer is A, 4,40,000. I hope it is clear to all. There is no doubt in this MCQ.
Always take care that when you're doing the set of provisions, you do it in the most beneficial manner to the assessee. Sometimes more than one manner will also be there, then it doesn't make a difference. But if there is a particular thing, if some income is taxable at a higher rate, like long-term capital gains, if nothing is mentioned, you have to assume 112 only. You can't assume 112A normally, because then it's a specified assets under 112A. If nothing is mentioned, you can't take it on your own. Either the section should be mentioned or the asset should be mentioned. Otherwise, you take it as 112. Likewise, if simply short-term capital gains is mentioned, you have to take it under the regular provisions of the Act. You can't assume 111A. So I think we'll conclude with this last question. Already we've exceeded the time.
Yeah, sure.
Huh? This itself is going to take some time.
Yes, because it include few more sections.
This is from deductions from gross total income. We've tried to cover as much as possible, but actually it's we've crossed the time limit also now. Okay, Mr. Arpit, an employee of MNO Limited, has contributed 161,280 towards NPS. Okay. And similar amount is contributed by his employer. His basic salary is 80,000 per month. DA is 40% of basic pay, which also forms part of retirement benefit. Okay, so 80,000 per month. 40% of 80,000 is 32,000. Yeah? 1,12,000 into 12 will be
13,44,000.
13,44,000. Okay, so this is the salary, annual salary. Now, he also paid 55,000 towards LIC premium for himself and his wife, medical insurance premium of 35,000 by cross-check for his mother being a senior citizen during the previous year 22-23. How much deduction is available under Chapter 6A while computing total income of Arpit? Okay, now what are the investments which is making? NPS. Okay, NPS is making, then LIC premium he's getting, and then medical insurance premium. Okay, so LIC premium goes under 80C, medical insurance premium goes under 80D. NPS is a challenging thing. It is 80CCD. 80CCD has three parts. It has a subsection 1, it has a subsection 1B, it has a subsection 2. Okay, 1 and 1B are employee contribution, and 2 is employer contribution. Why are we including employer contribution here? 80CCD2. PF contribution we don't include, employer contribution in 80C deduction. Why are we including here? Why we are including here is because employer contribution, first it is included as part of your salary. Entire employer contribution. MNO employee contributed 161,280. Similar contribution is contributed by the employer. 161,280 is included in salary. That is why deduction is provided under 80CCD2. Whereas in the case of PF, only the amount in excess of 12% is included in salary. That's why you don't get a separate deduction for employer contribution to PF. I just wanted to tell this difference because here also students tend to get confused. Okay, now, okay, Now 80CCD 1, 1B and 2. Okay. Now, one more thing which we have to tell, 80C also you get 55,000 LIC premium. Okay. 80D you get 35,000 because it's a mother who's a senior citizen. So 50,000 is the limit for a senior citizen. Nothing is mentioned. You assume senior citizen means it's normally a resident unless they've mentioned something else in the question. So 35,000 you get, that is clear. That's a clear cut thing. 80C is 55,000. But there is one provision in the Act which says whatever you get under 80C plus 80CCD 1 plus 80 triple C. Triple C is not there in the question. So, 80, so this will be restricted to maximum of 1,50,000. Okay. So 80CCD 1 may what comes? Employee contribution comes. Okay. And 80CCD 1B is an additional amount of 50,000 for employee contribution, but that is not subject to 80CCD 1B or 80CCD 2. These two are not subject to 1,50,000. Only 80CCD 1, which tells that 10% of employee, 10% of salary, employee contribution subject to a maximum of 10% of salary. 80CCD 1 says employee contribution subject to a maximum of 10% of salaries, at 10% of salary, that is allowable. 80CCD 2 employer contribution also up to 10% of salary, it's allowable. 1B is additional 50,000. 1B, it's outside 1,50,000. So we must always avail 1B 50,000 fully. Then it will be most beneficial for us because it's additional amount, it's not subject to the limit. Okay, now we'll go about it. Okay, 1344,000 is the salary that we must remember. Other things I think I should rub it out because otherwise we won't be able to do it. Okay. 1,34,000. This is the salary amount. 13 lakh. Okay, this also got rubbed. 13,44,000. So what is 10% of salary? 80CCD 1 means 10% of salary will be 134,400. Okay. Now, and 1B, I am going to claim 50,000. Okay. And 2 I get 134,400. That is not subject to any limit. It's employer contribution. Again, restricted to 10% of salary. Okay. Now, these two together, 80CCD 1 and 80CCD 1B together total to 184,400, which is higher than his actual contribution. It can't be higher than the actual contribution. Now, these two are in respect of employees' contribution. 161,820 is higher than 184,400. So, here I won't get 134,400. What I will get is 161,280 minus 50,000, which will be 111,280. You understand? Why I put 50,000 here first? Because it will be beneficial for you. Because this 80CCD 1 plus 80C also I am getting 55,000 na? LIC premium. These two together will be restricted to 1,50,000 anyway. So it makes sense to claim maximum under 1B. So 1B I have claimed 50,000. So remaining 161,280 minus 50,000 is only 111,280. So 10% of salary is coming more than that. So I'll have to restrict it to 111,280. I hope this is clear. 111,280 plus 55,000. This is under 80CCD 1. Now I have to restrict it. 80CCD 1 is 111,280. 80C is 55,000. So the total comes to 166,280. But these two together, as per 80CCE, I have to restrict this and this to 1,50,000. So I'll get only 1,50,000 now under 1,50,000 I will get in respect of
80C and 80CCD 1.
80C plus 80CCD 1. 80C is 55,000. 80CCD 1 is 111,280. Totaling to 166,280, but I will get only 1,50,000 because 80CCE says maximum deduction under 80C plus 80CCC plus 80CCD 1 will be equal to 1,20,000. Okay. 1B I am claiming 1,50,000 fully. 2 I'll get 134,400, which is 10% of the employer contribution. Okay. Now I'll rub this employer contribution. What happened there? Rubber. This also I will rub. All this I will. Okay. Now, so what does all this add up to? 2 lakh plus 134,400 is 3,34,400 plus I have 80D. 80D 35,000.
Which comes to 3,69,400.
369,400. Okay. So now I'll go up 369,400. B is the
correct answer. 3,69,400.
So you understood what I did? It is a little bit complicated because under ATCCD1, 10% of salary is allowed. Here, DA enters into pay. So salary, you have to calculate basic salary plus DA, 80,000 plus 32,000, 1,12,000 into 12. That is coming 33,44,000. 10% of that will be allowed under ATCCD1 and under ATCCD2 also, because the employer contribution is also restricted to 10%. So that will also be 1,34,400. Now, this we can fully take it as 1,34,400 under ATCCD2. ATCCD1B provides an additional amount of 50,000. So that we are utilizing it first because it is not subject to any limit. So when I am utilizing 50,000 here, 10% comes to 1,34,400. I can't claim that fully here because both together will add up to 184,400, whereas my contribution is only 161,280. So 161,280 minus 50,000 will be 111,280. That I have to add it along with 55,000 LIC, ATC, which comes to 166,280, which I have to restrict it to 1,50,000 because by virtue of ATCCE, reduction under ATC, ATCCD1 and ATCCC is restricted to 1,50,000. That's the reason why we fully claim this 50,000. Otherwise, I can claim partially here also. In fact, I could have claimed 134,400 here, remaining also I would have claimed here, but that is not beneficial. Beneficial will be to claim full amount under 1B. And 134,400 is under ATCCD to employer contribution. This is 50,000 is employee. ATCCD1 is also employee. This is employer contribution, which I'm including here because total employer contribution gets included in my salary. Add all the three, comes to 3,34,400 plus 80D medical insurance premium by way of cross check, otherwise than by way of cash. So cross check will also qualify. Mother is a senior citizen, so the upper limit is 50,000. So 35,000. So it will add up to 369,400. Is this clear to all of you? I hope it's clear. Bhumika, Naman, Dipanshu. Durga, you're correct. It's B. Deepika, Naman. Everybody, is it clear? It's the way you bifurcate between 10% of salary is allowed under ATCCD1 employee contribution. 10% of salary is allowed in ATCCD2 by way of employer contribution. Employee contribution may under 1B there's an additional 50,000, which we must always fully exhaust because that is not subject to the limits which under ATCCE. Once you exhaust that, remaining amount will go to ATCCD1. ATCCD1, I mean, that is not even subject to this 10% of salary. It's an additional amount. Then over and above that, you have to see ATC and ATCCD1, that you have to restrict it to 1,50,000. Bhumika says it's clear for her. What about the others? Naman? Dipanshu? Naman also has said yes. I hope all the others who have not participated in the discussion are also very clear. We wish you all the very best. In case you have any queries, you can write it at the email ID.
Or on the mobile app also.
Mobile app also, you can raise the queries, which will be answered. And all the best to all of you.
All the best to students. If you have any doubt, you can ask on the mail ID and as well as in the mobile app.
Study well, work out the questions on your own, compare your answers, solve all the MCQs and case scenarios web hosted on the website, MTPs, RTPs on your own. It's okay if you make mistake now, you can always correct it. It's better. In fact, it's a part of a learning process. You make mistakes, you understand what is the mistake you make, you correct yourself so that in the exam you don't make any mistakes or you make as few mistakes as possible. So that's why, so don't get worried if you're making mistakes now. You just consider that you're learning more. By making more mistakes, you're correcting yourself, you're learning yourself. But try to do it on your own. That will only help you in your exam conditions. All the best to all of you.
All the best, students.